Thanks everyone for joining us in the last SAM seminar of this fall semester. Today we are very happy to have Konstantin Milbradt as our speaker, and he's going to present Waiting for Capital with on-demand financing. So Konstantin, the screen is yours and you have 1 hour.
Thank you so much, Sami, for inviting me and giving me the chance to present this paper. This is joint work with Barney at UCLA and Simon at HEC. So the motivation of this paper is really from a very simple observation that most firms have limited access to outside capital markets. In other words, it takes time to raise capital, so they must engage in some form of liquidity management. And we know that firms conduct such liquidity management usually with cash within the firm or things like that. Now, we also know that just looking at kind of how firms are financing themselves, that there's some aspect that intermediation arises to fill this gap. So there's going to be many different and specialized intermediaries, and intermediation takes basically different forms in different countries. But from a kind of bigger picture story is that there's going to be an element to liquidity management that changes, or liquidity management is different when you have deep-pocketed but costly intermediaries. So if you think about an intermediary, the intermediary needs to be costly, otherwise the intermediary could just take over the firm and just hold it forever, and then we're done with that friction. So to have any sense of why intermediation arises and stays intermediation instead of just holding the firm outright, it needs to be costly. And so here, our intermediary provides financing in between rounds of raising new outside capital, but it's going to be partial. And it's going to be partial endogenously because the intermediary is costly. Now, when we derive the model, or when we derive the solution, something arises that looks very much like PE investing. And so what we're going to show is that all three aspects of kind of private equity are present. There's going to be the financing aspect, there's going to be the investment aspect, and there's going to be an operational aspect, kind of the improvement of some operational measures. So in other words, we're going to start with an abstract model where we have a relatively abstract intermediary, and we're going to derive a contract that looks, in our mind, very similar to what we would observe in a PE setting. So here's the model ingredients. So we're going to have a firm that's exposed to risky cash flows, that only has access to outside investors, think about broad financial markets, at Poisson times. And so really, what that means is that it takes time to find investors. We are not modeling why it takes time, and there might be a lot of interesting stories to that, but at the moment, we just take that. Now, existing risk-neutral outside investors partially control this market access. Okay, so the current owners of the firm, so to say, they're going to have something to do with this outside access. Now, there's going to be an intermediary, and what makes the intermediary special is that one, it has deep pockets, but two, what's really important is that this intermediary can supply on-demand financing. So this intermediary can kind of give you money whenever you need it instead of you having to wait. But that comes at a cost because using the intermediary is costly. And so for us, really, marrying a deep-pocketed investor with costs is really just a proxy for intermediary constraints. You might think intermediary, they have a certain amount of capital they can deploy for each firm. Maybe it's a bit of, but the more capital they deploy, the costlier it is. You just think about your regulatory constraints and so forth. There's going to be some cost attached to providing capital. And
Konstantin, can I ask a question real quick? So you said that the access to cash flow is coming with exogenous random Poisson times, but then in the second bullet point, you said the risk neutral outside investors are partially controlling this market access. So that makes it sound to me like there's something endogenous there. Yeah.
There is a small amount of endogeneity that basically, at most, there's going to be Poisson times, but there's going to be a max to the capacity. On the equilibrium path, they're always going to have the max capacity to refinancing intensity. but it gives us a non-commitment issue that is going to be important to think about.
Like renegotiation proofness. Yeah, go on.
Exactly, the renegotiation proofness. It's going to deliver renegotiation proofness in that.
Got it. Okay, great.
Oh, okay. All right, so we're going to derive this optimal contract, and then we're going to go kind of Basel preview that a bit. There's going to be kind of two-sided limited commitment here. And there's going to be limited liability by the outside investors, and there's going to be this limited commitment that the current shareholders, you need to give them something for them to be willing to look for outside investors. In sense, they cannot commit to contracts where they say, at the next refinancing, I completely dilute myself, and that's going to be costly. And so that's where the kind of partial control of the outside markets plays a role. And then finally, the initial risk neutral investors, think about them, if you want to think about it as founders, they set up the contract, but the contract needs to account for possible new future outside investors. That is, if you write a contract today, the new future outside investors are not part of it. So we want to have a contract that is stable once you add these new guys. Stable being a non-technical term here. I know I'm in front of a technical audience, but they're going to select the same contract. All right. So as a preview of the result, we basically have an integrated model of liability and asset side under market access constraints. So I know I flipped the liability and asset side around. I just realized that. So on the left, you have liability. The intermediary takes the stake that arises endogenously from the optimal contract. And the intermediary provides financing that's state-dependent risk sharing, essentially. And that this intermediary stake is going to look like the stake is going to be built up. And then when market access happens to the outside market, the intermediary is going to exit, which looks like a PE exit strategy. On the asset side, we're going to have liquidation, so that even though the intermediary has deep pockets, there's going to be some firms where the intermediary actually does not want to extend financing beyond a certain point. That's going to be linked to the risk, whereas less risky firms, the intermediary always kind of supports with financing so that the firm survives. We're going to have some investment results. These are rather standard. PE leads to non-monotone Tobin skew. That's something that you can get out of other models as well. Here it arises endogenously from kind of the financing. In other models, it arises when you have kind of a credit line that has slightly different features than cash. And we're going to have effort. So PE has more effort with a larger stake, but exit opportunities lower this average effort. So we're going to have, like if you think about PE having 3 elements, we're going to cover most of these. Okay, so the results is kind of, we have an overlapping packing order for firm financing. Of course, there's going to be subject to an implementation we pick, and here we pick a implementation where we have cash and credit line, and then additionally restricted equity. So when you have high liquidity reserves, you use cash and the credit line. They're not one-to-one. So that is, credit line usage is slightly different from cash. Think about credit line as committed short-term financing. And then when we're in a low liquidity reserve regime, we're going to have a credit line. And essentially, we start giving restricted equity to the intermediary because we can't run down our cash anymore. Now, what's interesting is when we think about refinancing opportunities as measured to access to the outside market, better refinancing opportunities reduce the set of firms that face liquidation risk. That is, from up here, we had this liquidation risk. But once the access gets better and better beyond some point, they basically reduce the benefits of intermediation. So at some point, you don't really need an intermediary anymore if it's very easy to find outside investors. Let me give you a quick literature overview. We're in a pretty time-constrained format here, but what we're essentially doing is we're taking liquidity management models, which is essentially models where there's just like cash and market access or some form of costly market access. So think about Bolton, Shah, and Wang, De Camps et al., or Abel Panagias. And what we're going to add to that is we're going to add an optimal contract model, in the sense that instead of having the stark division between outside market access and just running the firm completely internally on its own cash, we're going to add this intermediary that provides financing. And so in our model, that's going to take the form of risk sharing. So Hengji has a paper with Lee, and there's, of course, Rampani, Vishnavardhan, Bolton, Wang, and Ye. Now, sometimes these optimal contracts also come with added agency. For example, in Demazo-Sannikov or Hugo and Ye et al. Here, we take out the agency aspect. You can easily add it, actually, but it doesn't provide any interesting interaction effects, at least in our baseline setting, and it just provides kind of an additional constraint that you would have to have. Now, there's, of course, quantitative structural corporate liquidity management models. We kind of provide some kind of foundations for how to think about intermediation, how to think about financing. Now, there's an empirical literature on PE. So effectively, PE investors acquire a stake in distressed firms and so help resolve distress and more efficiently reduce the risk of liquidation of their portfolio firms. So that's from Bernstein et al., Gompas et al., and Hotchkiss et al. And we're going to find something exactly along those lines. But the intermediary mitigates a firm's financial distress only through the provision of financing. But in our model, in the baseline model, not through other centers such as operational and governance engineering. We're going to add later on these other two channels to show you that the model can also accommodate those. Okay, if there's no further questions, let me jump into the model. So agents here is a firm is owned by risk-neutral hand-to-mouth investors with a discount rate R that's also the interest rate of the model. So there's going to be no a priori impatience difference or so. The firm has a Brownian motion cash flow process with a drift. So the X is the cash flows. That's going to have a drift mu and basically a normal shock sigma dz. That's the Brownian motion. And so now we make a host of assumptions about frictions in the model. Now, otherwise, the firm is just worth mu over R and the model is over. Okay, so first we make two assumptions on basically liquidity. And so the first is that the cash balance cannot go negative. That's really just a technological constraint. There's no borrowing in the model that doesn't come from intermediaries. So cash balance must satisfy that M is positive, weakly positive. The second one is that there's costly liquidation. If you liquidate a firm, basically its production process dx blows up and you can only recover whatever cash was left in the firm. So you recover M, whatever is in the firm. Now we're going to make three more assumptions about the financing friction. And so we restricted cash holdings to be positive. We said there's liquidation. Now, how does this firm generate cash? Well, it either generates cash internally or it generates cash externally. So let's start with the external cash. First, there's investors. There's outside investors that are risk neutral, and they're the same as this. They're basically the same as these guys up here. And so these guys basically can be found at an intensity pi. And here, essentially, the outside investors pick an intensity F between 0 and pi. That's the search intensity if they look for outside investors. And they're going to raise this amount of funds from these outside investors. Now, outside these Poisson times, they cannot raise any money from outside investors. But outside the Poisson times, they can still pay whatever investors are in the firm, they can pay them certain cash flows. And so we're going to call that D-div. In preview, these are going to essentially resemble shareholders. Although at the moment, we don't make them shareholders yet, they're just owners of the firm. Now let's introduce the intermediary. The intermediary can provide financing. And importantly, the intermediary has a cash flow process DI that can be positive and negative. So the intermediary can provide financing, and you can, of course, pay off the intermediary if you so want to. But the important thing is DI can be negative, which is essentially the intermediary giving you money. Now, the intermediary bears a cost KT per unit of time that comes from the kind of dynamics of this process, and I'm going to specify that in a bit. Think about this, there's going to be a cost of providing these funds, and we're going to link that to the volatility that you dump on the intermediary in terms of the cash flow risk. Okay. Finally, there's an internal financing friction. As in all these models, I told you everyone has the same discount rate. So why doesn't this firm just accumulate cash until it's completely removed from any financial constraints? And what we do is we follow the literature, and we're going to say that internal cash basically has this cost lambda. So it returns R minus lambda. And so it's costly to hold internal cash. That makes the investors willing to pay out money instead of holding it until forever. Okay, so that means cash inside the firm is just the cash flow process of the assets under management. It's going to be the return on the cash the firm holds, payouts to the intermediary. So if DI is negative, these are basically cash contributions by the intermediary. Money raised upon market access or refinancing episodes. So when D pi is equal to 1, we call this refinancing. And then, of course, any payouts to the investors, GDIV. All right. So next,
Konstantin. Sorry.
Oh, Pierre, you go ahead. Yeah.
Oh, okay. So I had just very simple clarifying questions. So first one is, there are current investor and outside investors, and I have to think once outside investor invests, they become current investor in this.
Yeah, exactly.
Right. So they pay money once, and then they can't ever inject money after.
Exactly, they're hand to mouth.
Okay.
They're like the current investors are basically budget constrained, and when you want new money, you need to find new outside investors.
Okay. Okay.
But of course, the new outside investors are not part of the contract yet. So you write a contract with the current investors, and you hope that the contract is going to be such that they're going to attract outside investors. Once you attract them, the new outside investors become, part of the investor pool. That is, Did I answer your question?
That's the second clarifying question is the cost of the intermediary. So you, in the way you formulate the assumption, you seem to allow that intermediary pay a lump of money. So they inject
they can
strictly positive
value,
but the cost is a flow cost, or it's not a.
The cost is
it seems to allow that.
If you wanted to.
Anyway, go ahead. Sorry.
So originally we derived, or there's a micro foundation for KT that comes from a Kara intermediary, and so a Kara intermediary would, if you want this guy to give you a lump sum, that's going to be costly because you're going to kind of noise up this intermediary's. So you're asking, why doesn't the intermediary just give a huge amount of cash up front?
And pay a very tiny amount of cost because it's K times DT. Yeah.
Exactly. So here the problem is then the firm might just default and pay out the shareholders because there's a limit to how much the intermediary want to give the firm, and it's essentially costly to the intermediary to. But maybe let me wait until I show you the cost of bearing this fiction. There was another question. Semi, you had a question.
Yes, I have two clarifying questions. One is about the second assumption. So in the liquidation, only cash is recovered. So if we allow further in the case of liquidation, recovery of further value above and beyond the cash, is it gonna change the optimal contract, or is optimal contract gonna stay robust to that? That's one question.
So it should stay robust. At the moment we do this because we have a Kara micro foundation, and it's easiest to track with no recovery. So effectively it would change some of the this makes it a lot easier to think about. It makes liquidation easy because you don't have to think about how the proceeds are split, because M just goes to whoever has the most stake in the firm. I don't think having recovery here would change anything substantially.
Okay, so you refer to the Kara. So the intermediary cost K is gonna come from a Kara preference, right?
As a microfoundation, the only
As a
important thing
microfoundation.
is that this cost is essentially linked to how much volatility the intermediary has to take on.
Okay, so what's the significance that it has a subscript T? So what is
Oh, because
changing
it's
over
going to
time?
be linked. Yeah, it's going to be linked. If you give me 3 slides, it's going to be linked to kind of the risk sharing coefficient with the firm, and the risk sharing coefficient varies over the state of the firm. So that's just where the time dependence comes from.
I see.
So this is going to be induced time dependence via the time varying state variable. It's not going to be, time dependence on top of the state variable. If that makes sense.
Yeah, it makes sense. So I have a related question as well. So here it looks like the firm has some owners. I guess they are like shareholder, and they are risk neutral. The intermediary is the financing provider. Intermediary is risk neutral as well, but it's gonna have some type of cost depending on risk. So it's like intermediary is effectively risk averse.
Yeah, correct. So that's why the micro foundations is the intermediary is Kara. That gives us a certain cost KT. I'm going to show you what Kara does. From that, you can then think of more general forms of KT. They're harder to derive from. But effectively, what KT is supposed to capture is that there's a cost of funds for the intermediary. Essentially, PE funding is expensive. Intermediary funding is expensive. We know that from the literature, from the empirical literature. If it weren't, then the intermediary having deep pockets would just take over the firm.
I see. Okay, that's why we need that. Thank you.
Okay, so we're going to have an optimal security design problem. So a contract is a given set of policies, which is the payments to the investors, payments to the intermediary, or payments from the intermediary, and how much money you raise. It's incentive compatible if it fulfills the following 3 sets. So it's commitment to a contract. A contract can commit to via securities, ruling out unilateral deviations. But of course, that doesn't say that it's renegotiation. Now we're going to have 2 limited commitment issues. The continuation value always needs to be greater or equal to 0 from the intermediary side. So you can give the intermediary money, but you always have to be greater than 0. And here KS is the cost of providing financing. So effectively, that's going to be the value to the intermediary, and that's going to be the cost of financing, and that's the cash flows the intermediary expect, and the intermediary discounts at the same rate. Now, the investors have limited commitment. They commit to the securities they give out. But there's going to be one issue that they cannot commit to, and they cannot commit to the unobservable search intensity. Now, why is this important? Because it essentially limits how much they can promise to do in refinancing rounds. In other words, it rules out strategies in which they say, I'm going to completely dilute myself upon the next financing round. Now, effectively, these assumptions are kind of linked to the control rights in the firm. We can talk about that later. But essentially, we're going to assume that there are certain things that you can commit to, kind of the securities, but certain actions you cannot commit to, like the refinancing. So that kind of looks a bit like PE and VC. Now, of course, sometimes you can dilute equity holders, even if they don't want to be diluted, by just kind of screwing them over. If you think about the Facebook movie, one of the issues is they're going to raise money and they're going to screw over the existing shareholders. Assumption A4C essentially rules that out. Okay, it rules out these situations where certain shareholders can be diluted more and lose part of their stake. Okay, so then the optimal contract is investors have all the bargaining power. So the existing founders or investors, and they're going to maximize the value of their stake. And what's the value of their stake is payouts going forward. But of course, whenever they do financing rounds, they give up. If they want to raise this amount of cash, they need to give up that amount of cash in equity or in securities, because that's essentially, otherwise no one's going to give you that money. So you're going to have payouts and new financing. Think about this as dilution. Subject to that, the intermediary always has a positive, at least non-negative stakes in the firm, and initial cash is going to be zero. Okay, so here's the intermediary's continuation value. The intermediary's continuation value, dy, is going to have to respect the discounting of the intermediary. The intermediary discounts at y, and it's going to have to compensate the intermediary for the cost of providing financing. Now, you're going to have certain slopes of this contract with respect to the two exogenous, or to the exogenous process dz, and then with respect to, at least on the equilibrium path, with the financing strategy that investors always look for outside financing. And so that's going to be a martingale way. And of course, you know, the intermediary stake is going to be adjusted one-to-one with payouts or pay. Okay, so beta is the intermediary's exposure to the cash flow shock. Alpha is the intermediary's exposure to refinancing opportunities. You can think of this as thinking of alpha as the payment the intermediary receives, if it's positive, when a refinancing shock hits. Now, how do we interpret that? That's basically saying, when we get money from the outside investors, we use part of that money to pay off the intermediary, or in the much more realistic implementation, we give the intermediary some sort of vesting equity. And when market access occurs, the intermediary can essentially sell this equity to outside investors to generate this payout alpha. What's beta? Beta is basically how much of a cash flow shock the intermediary covers with, cash inflows and outflows, or how much the intermediary basically risk shares with the firm. Now, here's the intermediary cost.
Konstantin, just
Sam.
So next to alpha, inside the parentheses, we see small pi. Wasn't it the upper bound on the rate?
That's the upper bound. So here I'm already, f is going to be 0 pi. So this should have been f here. You're right. But in equilibrium, you're going to pick f equals to pi. This is an oversight.
Oh, I see. So anticipating the equilibrium already. Okay.
Yeah, exactly. All right. So next, we're going to have the intermediary cost. And here, we're just going to assume that the intermediary's cost increases with cash flow exposure. To be honest, it doesn't really matter if the beta enters linearly, or if you have a Kara intermediary. If you have a Kara intermediary, you will have this cost function with beta squared. Essentially, we need only a few things. And the one thing is we need that this thing, if you think of this as f beta, is f of 1 has to be equal to 1. That's the only thing we need for most of the results I'm going to show you. So if the intermediary covers all the risk of the firm, then the cost is going to be rho r times sigma squared over 2, where rho is basically giving you the kind of the cost of financing, or the cost of unit of volatility the intermediary absorbs. And of course, in a Kara setting, that is related to the Kara coefficient rho. Now, why do we have this kind of simplification here, KT? Well, first of all, we have a nice micro foundation for it. But really, what we think of it as proxies for financial regulatory constraint on the intermediary without basically generating a third state variable. Because at the moment, you can think there's going to be 3 state variables. Y, what you promised to the intermediary, cash in the firm, and possibly constraints of the intermediary. So we want to remove from that while still making an intermediary financing cost. Now, maybe to come back to Pierre's question, why doesn't the intermediary just give them a lump sum of money at the beginning? Well, because cash in the firm is costly. It has this kind of R minus lambda thing. So effectively, you want to take as little money as possible from the intermediary to effectively not accrue these costs of holding money in the firm. And then what we're going to make here is K is also going to be expensive. If you make the payments of the intermediary noisy, it's going to be costly to the intermediary. And we think this is a reasonable thing to link it to volatility, because if you just think about regulatory constraints, they're usually based on risk, how much risk the intermediary has to take. And also risk is going to determine if the intermediary, say you take a real world example, has financial constraints somewhere, the more noisy you make the payments of the intermediary, the easier it is for the intermediary to hit those constraints. All right, so now maybe just to set the stage, if the intermediary, at least in this setting, would own the whole firm. So suppose the intermediary just took over the cash flow process dx and held it forever. With this cost function or this cost function, as long as when the intermediary holds the firm, beta by definition is 1. The intermediary is fully exposed to the cash flow risk. And so we're going to have mu minus R. That's, of course, the NPV of the project in a frictionless market. And then we're going to have this risk adjustment here by the intermediary. That's the intermediary's autarky value of holding the cash flow forever. The first base is, of course, just mu over R. And so we know that the value of the firm, which is the value to the current shareholders, the value to the intermediary, minus whatever cash is in the firm, because this is net of the cash, we should net out the cash, that's going to be the firm value. And we know that's going to have to be between these two boundaries. If it's below that, if it's below the intermediary's autarky value, the intermediary should take over the firm, and it clearly cannot be above the first step. All right, so we're going to reduce our space, our state space. So you might think M and Y are two state variables. What we can show is that excess liquidity is actually C. The difference between these two is going to operate as the unique state variable. Why? If you just think about it, C is invariant to transfers. In other words, if I increase cash by $1, where does this cash come from? Well, absent our market access, it has to come from the intermediary. And so by the promise keeping constraint, the intermediary's value has to go up $1. So C does not change with respect to DI. And consequently, we can think about freely adjusting Y as a control variable. Now, it's not a fully unconstrained control variable because we still have a liquidity constraint M greater than 0. And we have an intermediary's kind of limited commitment constraint that Y has to be greater or equal to 0. Otherwise, the intermediary just says, okay, I'm just going to walk away from my commitments. So Y has to be greater, combining these two, than the negative of C and 0. Now, you might think, how do we get C negative? C negative is essentially when M is 0, but Y is greater than 0, we would have C negative. And we're going to talk about how can C negative arise. And that's basically going to show up in a few pages. But now let's think about the investor limited commitment. So that's PC is the investor's value function. So PT is equal to P of CT. And when we set the firm net value of cash was plus Y minus M, but that's of course just equal to minus C. And let C star is just the, after we refinance, we have market access. That's where we want to move the firm to. And so the investor limited commitment constraint can be written like that. Current investors only search, and as you might have imagined, this is a bang solution. Investors are risk neutral. If the refinancing strategy alpha leaves them not worse off. In other words, suppose you move to the value function PC star because you jumped from C to C star after refinancing. You have to pay for this move by giving out equity to raise delta M exactly. And you're going to leave your previous value. Now you can rewrite that as the difference between PC star minus PC plus the cost of raising financing. And so effectively, this is going to restrict what alphas you can commit to. Effectively, what we're not allowing, and this is important because this is very different from the optimal contract literature. In the optimal contract literature, I can say, look, I can commit to arbitrary payments. So I could say, next refinancing round, I'm going to raise 1 trillion, and I can pay you whatever you want as the intermediary. I can make payments alpha that are like, unconstrained. Here there's basically 2 restrictions on alpha. One, alpha has to be such that the investors that are in the firm are not made worse off. But also we're going to see that this essentially also constrains alpha to not be beyond the value of the project. Because the value of the project at most is mu over r. And you cannot run strategies in this model where you make payments or where you raise money that would raise more than mu over r, for example. So this constraint here naturally imposes that. So there's going to be constraints on the firm that come from this investor search. Now, we could also allow the investors, we could take this out, but we could allow the investors, for example, to fully dilute themselves. So how do you do that? Well, you essentially allow them to have whatever continuation value is 0. But that still doesn't mean that they can raise arbitrary amounts from outside investors, because the outside investors still need to get fair value for whatever investment they're making. So even if you allow current investors to completely dilute themselves, to set the value P, C star, to set the value of the new investors, of the old investors to 0, that still leads to a constraint. Okay, so we're just going to take the one that we find is more reasonable, that these guys actually have to be willing to do the capital raising route. Okay. And so we're going to summarize, of course, this, as you can see, alpha, take alpha to the other side, that's going to restrict alpha to be in a certain set. That's, of course, going to be a function of the value function. Now, here's something important, is you're going to have renegotiation coming from at least this assumption where investors pick their search. Because effectively, if you know you're not going to get diluted in the future, it guarantees that the contract is consistent with decisions of future outside investors. It rules out bilateral deviations. So in other words, there is no way this model where the investors and the intermediaries can get together and renegotiate to a better outcome. Okay? And of course, if outside investors are present, what we're going to show is that you pick C star so that the value of the firm is maximized. So there's also no renegotiation in that scenario, because there's essentially 2 scenarios. Do you have market access or not? In both scenarios, there's no bilateral deviation or renegotiation that would make things better. Okay. So now here's the optimization. Yeah.
So this is true if alpha is going to be positive, or excuse me, if f is going to equal pi. But is it the case that you always in equilibrium want to be searching for new outside investors? And if so, like why? And if not, does that cause problems for the renegotiation proofness?
No, you always want to search, because at least this constraint just basically tells you you're not made worse off. So at least for that contract, it's good for you to search. Maybe you even make some money of it. Maybe your value goes up a bit. In equilibrium, it exactly makes you indifferent. And so this indifference condition, it's better for firm value to commit to raising money.
So, but what is it about the underlying environment that makes me always want to raise new money?
Because outside investors are risk neutral and the intermediary is costly. Okay. All right. So we have this complicated HJB.
Konstantin?
I'm going to show. Yeah.
So also it's important that there is no search cost, right? there was search cost, you would basically compare alpha with the search cost and decide to search.
Yeah,
or
exactly.
not.
So if there's search costs, we have an extension in the model. Essentially, you only search in scenarios where, you know, like if you are really well capitalized at the moment, you still search. If you're close, I haven't shown you, there's a payout boundary. If you're close to the payout boundary, you still search because it's free.
Mhm.
If search had a cost, when you're well capitalized, you don't search, and when you're less well capitalized, you do search. So that doesn't really change the mechanisms of the model. It just changes some of the kind of numerical quantitative results a bit.
Thank you.
All right. So the first thing here, I'm just going to show you this HGB. It's pretty raw. I want to highlight two things. Beta is how much volatility do you dump on the intermediary? And what you see here is that, of course, that lowers the volatility of the state variable C, but it's costly because this is essentially KT. Now, as I said, in Kara, this would be beta squared, so it doesn't really make much of a difference here. What I want you to see is that Y is always entering negatively. And so essentially what you want is you want to have as little continuation value with the intermediary as possible. And so going back to Pierre's question at the beginning, you don't want the intermediary to give you a lump sum, because that's essentially, of course, I made a mistake here. This is lambda. This is the cost. This is the cost differential between what the firm earns internally on cash and what the market discounts at. And so effectively, Y creates that wedge that's costly to you. So you want to have as little Y as possible. Usually you want to set Y equals to 0, but that might imply, if you set Y always equal to 0, that, let me get to that. Okay, so Y is sometimes positive, and that's Y is positive when M is equal to 0. All right, so payout boundary, this is really standard. This is on all the cash holding models, so we're not doing any innovation on that. There's an upper payout boundary, and so investors are essentially shareholders. Investors don't pay themselves anything between some lower bound C and an upper bound C, and at the upper bound they make payouts. Optimal Y, as the slope of the value function is positive, they're going to have Y is equal to 0 or minus C, the maximum. But what that implies is that the cash holdings of the firm are equal to either the maximum of C or 0. So effectively, what we're going to get is when C is positive, you hold cash in the firm, but you don't make promises to the intermediary. When C is negative, you don't hold cash in the firm, and essentially you finance yourself with promises to the intermediary. So you basically have, as C turns negative, you go from a kind of cash and, you know, there's going to be some risk sharing beta firm to a firm that finances itself with promises to the intermediary and risk sharing, instantaneous risk sharing with the intermediary. And so we're going to interpret Y as deferred payout financing. Think of this as a stake in the firm. And I'm going to show you exactly how the stake in the firm arises. Think about full ownership of the firm of the intermediary. Beta equals to 1. But suppose the intermediary has the option with intensity pi to sell the firm to outside risk neutral investors. The expected cash flows net of costs for the intermediary as is going to be mu minus rho r sigma square over 2. That's essentially KT, or when we have beta equals to 1, that's the cost of the intermediary of holding. The resale opportunity is going to be, well, we're going to resell it for P C bar minus C bar. Of course, we have to raise this amount of cash, and we're going to get a value function like this. And so that's essentially the value of the firm that we create when we sell it, and we can appropriate that from the outside shareholders. The outside shareholders get fair value, and we make whatever value is created. So the total expected value of the firm is going to be exactly equal to a weighted average between the autarky value and this resale value. And effectively, that's going to be the maximum promise we can make to the intermediary. We cannot promise any larger things to the intermediary because that's the max that we can promise. If we promise the whole firm to the intermediary, including the resale option, that's what the intermediary would value that. And so the lower boundary now is going to be C lower bar is going to be the lower of the liquidation or the survival boundary. The term liquidates when C lower bar is equal to 0. Would the intermediary want to bail out the firm and take over all the risk when C is equal to 0, when M is equal to 0, when the firm is out of cash? The intermediary is only willing to do that if there's value to ownership. So C lower bar is equal to exactly the negative of this. So that's the maximum promise. Now this thing could be negative because Y, the autarky value, could be negative. But of course, if you have high enough intensity with which you can access outside markets, even when the autarky value is negative, the intermediary might still be willing to bail out the firm when it reaches 0, because this promised value of holding the firm forever is mainly driven by the resale option. So that looks very much like PE. Firm is in trouble, they have trouble with cash, they don't have easy access to markets. You step in, you give them basically these short, you say, okay, we cover your cash flow shocks, but we basically provide bridge financing. And in return, the intermediary gets to sell the firm at some point and make some money off that. Okay, so risk sharing when the firm defaults at 0, beta is below 1. Okay. When the firm survives, that there's no liquidation, there's going to be some C lower bar at which beta is exactly equal to 1. And that's the red line here. Of course, there's going to be, when C is negative, there's going to be a slight difference between the actual cash flows the intermediary makes and the value function volatility of the intermediary. But in the interest of time, let me move on to the kind of implications of this. So this is really the main graph of the paper if you want to think about what does intermediation do. So let me draw a line here. To the right of this, and on the horizontal axis, we have 1 over pi, which is basically expected time until market access. So when you have bad market access, you're in a normal model in which you die when your cash reaches 0. This is C on this axis. And so you should think of this as M greater than 0. And down here, M is equal to 0, but Y is greater than 0. And here, Y is 0. Okay. So this is, let me just write this here. This is cash financed up here. And this is promises financed. Okay. The important thing here is until this point here, the firm still liquidates when it hits 0. Now, in contrast to like the traditional decamp and other models of cash holding, there's going to be some improvement to the risk sharing because beta is greater than 0. So the intermediary is going to absorb some risk. It's going to lead to slight improvement in the cash flow process. But that's really just a marginal effect. The big effect is beyond this point to the left. Suddenly the intermediary finds it valuable to take equity stakes. That is Y greater than 0 below here. And that makes the intermediary willing to bail out the firm when it runs out of cash. That's of course costly because the intermediary is costly, but that really leads to this discontinuous. You see the kink here. And so now you can really reduce the payout boundary up here. And instead you use this promises-based financing. And so that's kind of the first result of the paper that we think is really novel, is that you have this shift from kind of normal financing, which looks like kind of arm's length, to kind of this more promises-based financing, which looks like an equity stake. So here in our implementation, we think of cash. The firm uses M to partially buffer cash flow shocks, and C is greater than 0. The contract with the intermediary, just to give you an interpretation, beta, think of this as credit line financing, kind of committed short-term financing. How much do you draw on the promises to the intermediary? Think of Y as intermediary restricted equity financing. That's the stuff that the intermediary has to get in addition when C is negative. And then alpha is a payment that the intermediary receives when you have market access. So alpha is both a credit line repayment, but also the resale value of the intermediary stake. So what's interesting when you have the Kara setup, you can actually show that unconstrained, without this alpha constraint that I gave you initially, you know, where these guys have to be made to participate to raise money. Without that constraint, you can show that alpha essentially adds to, just comes out of the model to exactly the sum of payments that the intermediary has made until today. So in other words, it looks exactly like a credit line repayment, where the face value of the credit line is just the undiscounted sum of all payments that the intermediary has made, or the cumulative sum. And then you pay exactly that off. Now, when you have that restriction that these guys need to be made to participate, you essentially need to incentivize them to do that. And you need to lower the repayment on the credit line. Essentially, there's going to be debt overhang. If there's too much owed to the intermediary, the investors don't want to raise new funds. And they only do it if you give them a bit of skin in the game. And that means you have to reduce the payment to the intermediary. All right. Now, here, we don't have the Kara specification. We just have K given, and I gave you a K. We still have an overlapping pecking order. So when C is positive, the firm finances with cash and credit. When C is negative, it finances itself with changing the restricted equity Y and the credit line. And market access essentially looks like an exit strategy. Firm issues equity to outside investors, and the credit line is prepaid. And if the intermediary has a stake, the intermediary exits the stake. All right. Alternative interpretation is collateralized debt or debtor in possession financing. Now, let me talk about PE.
Just a reminder, we have 10 minutes for the normal seminar time, then we are going to have the Q&A.
Exactly. So PE involvement really takes three forms if you think about the PE literature. There's the financing part, the investment part, and kind of an operational part. Here, what I showed you so far is really financing. Intermediary dynamics really resemble that of the PE investors. You acquire distressed firms when M is low, and you provide capital in exchange for a stake Y. And effectively, you hold these firms primarily to realize capital gains upon exits. So when the market access is high enough, the intermediary is willing to assume full ownership, even if the autarky value of the intermediary holding this firm forever is negative. So without market access, the intermediary wants nothing to do with the firm, but there's going to be a level of market access in which the intermediary suddenly participates. And so the intermediary can have a capital gain. Now we have some measures here. The outstanding stock of PE investment, YT, proxies for the total size of the PE sector. And of course, we have a deal flow, pi times Y. That's how much intermediation is done at each point in time, or how much exit there is at each point in time. And so essentially what we're going to show you, just concentrate on the left in the interest of time. There's going to be the time to market access here. And this is the PE activity is essentially no monotone. And that makes sense. When you have very bad market access, you're all the way on the right. Intermediaries don't want to take any stakes. So at some point, this thing is going to go to zero. When pi is equal to infinity and there's almost no time to market access, intermediaries, sure, they take positions, but they're really not needed because you can just wait and have outside investors come in immediately. So really intermediaries are highest activity in the interim, when there is some market access, but enough of a friction that you cannot find outside investors quickly. And so then let me go to the second one. Actually, the investment part is really standard. Like if you think about PE involvement, having financing, investment, operational, you can add a capital model to it. You can have a capital. Of course, when you want capital, you need something in which essentially things scale. And so that's where we get kind of the cost of intermediation. We make it exogenously scale with K. So clearly Kara could not microfound that anymore because Kara is not very scale friendly utility specification. So really now we're moving away from the microfoundations. And so if you have that, you get exactly the same thing as, say, you get in models where, so in Boldenstein Wang, you have this thing where there's a credit line that's exogenously costlier than other parts of cash holdings. And so if you have that, you also get that, you know, the investment is going to interact with the Q theory. Now, I want to mention two things that are kind of different. The lower boundary here is, can you guys hear me? My headphones just ran out. No.
We can hear it.
You can hear me? Okay.
Yeah.
Very good. So the lower bound is, of course, now endogenous to the investment at the lower bound. And so there's going to be a lower bound in the C space, but that now has an endogenous link to the investment function. So the first firm is not pure autarky value anymore, as the refi opportunities pi influence the investment link. So you're going to get some more feedback effects that interact with the optimal contract part of the model. You're going to get some non-monotonicity in Q, but that's already in the previous page. So really, that's where they assume exogenously some credit line that has a certain cost. Here, we don't really assume that it comes from the cost of the intermediary in our model, but nevertheless, this is not really new. What's new is that the refi opportunities influence the investment. So that's kind of, and that changes the contract and the maximum promises you can make. And so finally, with PE, you have no disinvestment in the model. Without PE, the firm might use disinvestment close to zero, close to the boundary. So PE really helps investment or overcome investment frictions. Now, finally, I can briefly give you an operational extension of the model. So if you think about PE, a lot of people think about, okay, the PE guys come in and run the firm more efficiently. Suppose now that there's a non-contractible intermediary F at AT that enters cash flow dynamics additively. So move away from the having capital in the model. Let's go back to the kind of Brownian motion scale freeness. But now we have AT is just the effort of the intermediary. If there's quadratic effort costs, then you can just solve the model in the HJB. And essentially what you would get is you get that the effort of the intermediary is going to be a function of the efforts of beta, the stake of the intermediary, or rather, beta is the exposure of the intermediary to the volatility. So when beta is high, the intermediary has a lot of effort. And so effectively what you get is intermediary effort high when the firm survives. Because when the firm survives, beta can go almost all the way to 1. When the firm defaults or liquidates at 0, beta never reaches 1. And so one of the kind of nice results that we have is the intermediary effort is really highest when it is involved in this whole exit strategy, building up a stake. But conditional on survival, higher market access pi, of course, lowers the average effort because you never really run into the high beta region. So this kind of makes sense. When you have a low market access and you take a stake in the firm, you know you can't get out of it easily. You're going to take larger and larger stakes, you're going to put in more effort. But if you can get rid of it relatively easily, that really doesn't make much of a sense. So the ability to sell a firm quickly causes something akin to short-termism because your beta risk sharing parameter never really reaches really high values because you exit them so quickly. And so I have like a few more minutes, is that correct? So at the end, I want to show you two things. One, I'm going to show you two benchmarks for kind of baseline calibration of the model, and that this is not really calibration dependent. I just want to show you the benchmarks of, you could think of no intermediation. So alpha beta is equal to 0, basically.
Real quick. So sometimes we see public firms going private. What can your model say something about that?
No, so in this model, at the moment, at least the way we set it up, is that the firm's kind of environment does not change in the sense that pi is always the same. So it's essentially, there's no difference between C negative. We think of this as more private, or C positive, which is probably when the firm is still publicly listed. We could do is we could have regimes where the access to kind of outside financial markets might be kind of a ladder. If you're private, pi is not as high than if you're a public firm. But at the moment, the model does not have that element. It just has kind of hand-wavy interpretations of that.
Mm-hmm. And yeah, another related question I had was, have you thought about endogenizing pi? No.
Yeah, so we have an extension in the model where you can pick pi, like the maximum level of pi according to a cost function. So as you would guess, having pi when you're flushed with cash is not very valuable. So you have a relatively low pi there. And then when you're out of money and the value of cash in the firm, the marginal value of cash is really high, you would pick a higher and higher pi. So effectively, you look more intensely for investors when things are not going so well than when things are going well. But that's really, it's a relatively easy extension, but it doesn't add like any interesting mechanisms we thought that, you know, are not just, as you would guess, the kind of first order. But so let me give you these two benchmarks before I wrap up. So the first benchmark is, if I never use an intermediary, alpha beta equals to 0, almost always give me y equals to 0. So there's never any intermediation going on. And the second benchmark is, let's call it the no PE benchmark. You can still do risk sharing via what we think when beta is positive, what we kind of interpret as a credit line, but you can't let the intermediary take a stake in the firm, no Y. And so essentially then we want to measure the value of the company at its highest point. So at inception, at C upper bar. And so effectively what we want to do is, how much is the value of the firm when we don't allow intermediation, and how much additional value is when we have PE. So effectively we take the full value of the firm in the full model and we divide by either the no intermediation case or by the no PE case. And so here, the first thing to note is, of course, intermediation adds a lot. So that's basically the value created in percent. The baseline is just the normal kind of run-of-the-mill cash holding model in the literature, where you can't get any more cash in between defaulting at 0 and paying out money at the upper bar. Of course, if you allow intermediation, well, let's think about, if you allow intermediation, that kind of can avoid liquidation to the left here. And even when you have still liquidation to the right of this king, it's still, you know, the risk sharing still is valuable because it lowers the volatility of your cash flows state by state. Now, PE over and above, allowing PE over and above just simple risk sharing, that is allowing Y equals to Y greater than 0 is basically this line. That adds a lot of value even on top of the risk sharing. So of course, when the firm defaults to the right of this king, Y is never positive, because when C hits 0, the firm liquidates. And we know Y greater than 0 only arises when C turns negative. But we can still see that, at least in this calibration, you know, we have up to 15% of value is created by allowing the intermediary to take PE stakes. Okay, so that kind of goes a bit towards allowing PE stakes allows better risk sharing between the firm and the intermediary, even though the intermediary is costly. And this all works via the promises that we are able to make to the intermediary. And of course, the important thing is that this whole model has an endogenous limit on the promises you can make to the intermediary. So this model does not allow you make unlimited promises to the intermediary gives you money, and then everything runs forever. Because the intermediary essentially, you know, needs to get value for the money it gives you. And once you have the money in the firm, it's very costly to have the money in the firm. All right, so let me wrap up. There's a host of empirical implications, but I think I'm out of time. So let me wrap up. So we present an integrated model of liability and asset size under market access constraints that resemble what we think of a PE setting. On the liability side, we have an intermediary stake that arises endogenously from the optimal contract. And we have financing that is basically state-dependent risk sharing with the intermediary. On the asset side, we show that liquidation can happen even when you have a deep-pocketed intermediary, depending on how much the autarky value of the intermediary is and how much the resale value of the firm is. We showed you some investment. I briefly went to the investment thing and the effort thing. But effectively, the effort thing is the PE has more effort with a larger stake. But of course, exit opportunities lower the average effort level. And then finally, we do a look at the implementation of the optimal contract. We have an overlapping pecking order for firm financing. We have high liquidity reserves. You essentially use cash. and what we deem something that looks like a credit line. And when you have low liquidity reserves, you get a credit line and restricted equity. Better refinancing opportunities, higher PI does not necessarily mean that you have more PE. It reduces the set of firms facing liquidation risk. But of course, beyond some point, it reduces the benefits to intermediation because you don't really need the intermediary to step in as urgently anymore if it takes you like a week to find outside finance. All right, that's basically it. I'm happy to discuss any of the open questions that are there. Thank you.
Thanks, Konstantin. So now we are gonna move to the Q&A part of the seminar, and panelists can continue to ask questions. But also, if there is any question from attendees may raise hand using the raise hand function of the Zoom, and we are gonna allow you to ask your question live.
Can I ask something while we're waiting for attendees? Something like, yeah, so very super nice, very good. Just so you presented that lambda cost of cash. It sounded like a bit of like a technical thing for the problem, but I have to. So is this some story people say in the literature about it? And second question is, since you've put numbers on the thing, can you give us a sense of how large it is? And when you do comparative statistics with respect to R, what do you do about that lambda?
Okay, so first off, this whole literature basically suffers the problem that cash in the firm is an issue. You should see firms just saving all the cash they have forever to save themselves out of the problem. And so effectively what you need some mechanism for them to want to pay out cash, before they reach infinity. And so the literature basically does two things. Either you make the outside investors more impatient than the firm, so there's an incentive to pay out cash, or you put this wedge on just the internal cost of holding cash. They're basically equivalent. It's essentially just a technical thing to get the firm to pay out cash early. Early as in before it reaches infinity and no constraints are there anymore. At the moment in our paper, I think we have the interest rate is 5%, and I think we have lambda equals to 1%, internal cost of cash. It really, of course, the smaller lambda gets, the more you see cash accumulation in firms. So if lambda is like 10 basis points, C bar is going to be a lot higher. And then, of course, you're going to use the intermediary has a cost function K. And so it's essentially like the trade-off is using cash in the firm costs me a certain fraction, and using the intermediary costs me something. And so if we make holding cash in the firm cheaper, we use the intermediary less, we accumulate more cash. So from a theoretical perspective, there's no issue. Of course, from the quantitative side, you're asking how much
R. So when you set R very small in the comparative statistics you started, and when you said R very small, lambda follows like in the same way, or you said?
Oh no, here we just do. I think we keep lambda the same, and we just do R minus lambda. So the return.
It's R minus lambda everything. Yeah. Gotcha.
But we could also do like that. Maybe lambda is scales with right. R. Like we could do that as well. If you, we didn't really put much. I didn't put much emphasis on the comparative statistics with respect to R. But if you care about them, we can do some robustness on them.
Okay, awesome. Thank you.
Yeah.
Okay, can I ask you a question about some limiting conditions? So, okay, if there was no friction, the firm value will be mu over R.
Yeah.
And so, for example, if pi approaches infinity, are we gonna obtain that first best, or?
Yeah, we're gonna obtain the first best.
I see. So it doesn't matter that there are other frictions like. Cash reserve M cannot be negative. So if pi is infinity,
exactly. So
effectively doesn't matter.
Let me just go here. Effectively, when pi goes to infinity, you're here. Now, pro forma, C upper bar goes to 0. C lower bar goes to mu over R. That's the most you can promise.
Because what's the most you can
I
promise to the intermediary? The whole project. The intermediary can turn around and sell it in 5 seconds to outside investors who value it at mu over r. But of course, the interesting thing is, even though you can promise this much, you never actually make it away from that point because the resetting is so fast.
Mm-hmm.
And so that's why you approach mu over r, even though it looks like there's a range of, C that you might have.
I see. And okay, what if pi is finite, but we don't have the constraint like m has to be positive? Then are we gonna still obtain?
I mean, when m doesn't have to be positive, then you get mu over r again, because effectively you're just borrowing at the market rate at that point, effectively. So that's essentially, we're essentially giving you a model in which we kind of tell you, yeah, you can borrow. The borrowing costs are endogenous. They come out of this optimal contract problem, and you can just kind of think of involving the intermediary as risk sharing / borrowing.
Mm-hmm. I see.
So it's kind of a dual function here. Of course, risk sharing, borrowing comes from risk sharing. If you have negative shocks that hit the firm, they lead to borrowing in that sense.
Yeah, in most of the search-based asset pricing type papers, it is always assumed like, there is no constraint equivalent to m has to be positive. So in those models are, yeah.
Exactly. So I know you guys are a more search-based audience. So the interesting things here is kind of, can we think of a way in which this is a one firm, one intermediary model, but there might be interesting things in terms of interaction when, the easy thing to integrate is if the outside investors have some bargaining power. So if the new guys have some bargaining power, you need to give up more than just fair value to them. So that's relatively easy to integrate, and pi just has a bargaining friction in front of it, and so it kind of goes lower. The more interesting thing is, at the moment, we don't really have a model of intermediary competition. We just say they're competitive and they all have the same cost function. So there might be some element to, it would be interesting to see if we can have some kind of model of intermediary competition. I don't know how much more difficult it will make the optimal contract. I suspect significantly, but that's basically where I think the interesting things happen. Because if you go along with my PE interpretation, it's really just that, there is something in that contract that looks kind of like baseline risk sharing, and some looks like more like equity stakes. And it would be interesting to see what if these guys start competing, or not fully competing, so to say. Yeah. Now maybe. Yeah, any other questions?
Yeah, is there any
There's
other
one
question?
Well,
I'm gonna ask. Oh, sorry, go ahead.
Yeah.
Sorry,
Thanks, Jonas. So I have I guess due to the time constraint, you didn't talk very much about liquidation. And it was just in kind of understanding the situations and likelihood of liquidation in terms of, for example, in this picture, the refinancing probability and how much interest rate premium would be charged on top of the risk-free rate for potential liquidation risk. I imagine is it monotone or non-monotonic?
So, okay, so maybe to take a step back. So we have liquidation because sometimes the promise of full ownership to the intermediary, because the intermediary's cost is insufficient to make the intermediary willing to even hold the firm for a limited amount of time if there's outside options. So that's where the liquidation comes from. Are you talking about the implementation where we give you a credit line and we calculate the credit line interest rate. Okay, so in that sense,
right, understanding the right, like in addition, isolating out the PE part, the intermediary traditional role of credit line parts. How does that interact with the refinancing probability? And that part seems to be less discussed relative to the PE role, but it seems like it's not so trivial either to understand. Or
so I guess in any optimal contract model, you basically have the payments to the intermediary DIT, and you have the stake in the firm of the intermediary Y. Now, how you implement the payments DIT is really up to the modeler. Now, what we found is when you have a Cara micro foundation and you have no constraint on alpha, we have a constraint on alpha, but if you have no constraint on alpha, what you can show is that the integral, the undiscounted integral of DIT, that is all the payments to and from the intermediary, essentially without a constraint, what you can show is that alpha T is equal to DIT. Now, since the last refinancing. So essentially, what we're saying by that is, even though we don't assume anything about the implementation, what we can show is that the payment upon market access seems to be exactly the undiscounted sum of all the transfers between the intermediary and the firm since last refinancing. And that looks very much, in our minds, like a debt contract, where the face value is just, how much did you borrow? And then that's what you get back, alpha T. Now, of course, what this implies is that there's going to be an implicit interest rate on this object. And we can calculate that, and that's basically increasing. And it covers, so this is when alpha is unconstrained. In reality, what you're going to have is that the alpha you pay out is going to be less than the integral. Why is that? Because there's essentially that overhang. There's situations in which these guys don't get enough skin in the game to be willing to refinance. And so in that point, then effectively what you have is you need to compensate these guys for the loss upon refinancing. That is, you need to compensate the intermediary because the intermediary is not going to be paid in full. So there's going to be a higher interest rate to basically compensate for that wedge. That is, you don't get paid in full. Now, there's a second thing is if there's liquidation in the model, there's of course also default risk on this contract. And again, the intermediary credit line is going to acknowledge that by having a higher interest rate because they know there are situations when cash runs out, I will not get paid back. And so those arise endogenously out of the model. I don't know if that addressed your question. Though.
Yeah, it does. Thanks.
It did? Yeah.
Ioannis, do you have a question? I thought you were.
I appreciate that. I'm not sure about the value of it, but since there's not too much competition, I'll ask. So what I'm thinking is maybe a big picture about what exactly makes, so this is like a cash problem, but from a modeling perspective, can you think of it as some kind of liquid asset in general? I mean, other than the thing being a unit of account and having this non-negative constraint, is there something else that makes cash in this problem other than think about it as a very liquid asset and all the returns and the lambda cost being implicitly adjusted, or there is some cashness in that cash?
You mean like in terms of kind of the theory of money in those?
I mean, either, from a monetary economics perspective or some,
Yeah, so here, I guess.
In general, yeah.
I guess here, cash, what makes cash here is that whatever the assets produce is in this unit of account, and that this unit of account cannot turn negative. And that for it to turn negative, you need other things in the model that allow for promises to be made and to be repaid. And I think it's these promises that are essentially expensive when the intermediary is involved.
I see. I see. So, okay, so you could think of it as like a real model with these constraints in any case, right? It's like, again, as you said.
Konstantin, we cannot hear you.
Can you hear me?
Yes, now we can.
So I lost my train of thought here. Yeah, so essentially, when you think about these kind of Damaso-Sannikov models, you can make promises up, like you can make like crazy promises to get the contract to work. And so here, essentially, all we're trying to do is, here's a model where cash exists, and cash imposes constraints on the promises you can make in a way that it wouldn't come out of these normal kind of optimal contract models. And of course, once you have cash in there, there's all these other things that we think cash does is kind of like, it's hard to raise cash. But on the other hand, making promises also requires you to have some commitment that doesn't just come from trust me. It just comes from, okay, there's assets underlying all this. And these assets basically back my promises. And that's essentially where this last slide basically comes from, is the maximum promises I can make is I give you everything I have. And everything I have might not be sufficient for you to be willing to continue giving me cash. So if we think of cash as one of the main properties of cash, it can't turn negative. That's essentially the main property of cash in our model. It cannot turn negative. And so then, you have this natural contracting problem where, how do I make sure that whoever extends credit to me feels like they're not going to get screwed over in the future?
Gotcha. It's pretty powerful that it can have this simple, like, unit of account property can have such big contracting implications. Seems pretty, maybe, people in the others know it. I found it pretty impressive, pretty cool.
Well, so I mean, everyone knows, and like without optimal contracts, it has this property, but usually what people do is they just exogenously put credit kind of things into the model. Like they just say, oh, here's a credit line and it has a higher interest rate. We don't really know why. And so here we just wanted to just kind of integrate it in a consistent model. We're trying to write a consistent model, I think. Any other questions, concerns?
I have one last question. So Bachimek asked about this endogenizing pi.
Yeah.
So I guess it's mostly a technical question. So if we add such a thing to this model, do we have to assume the cost of choosing pi has to be quadratic?
Let me just find my my paper here. Maybe I can just share it. No, it doesn't have to be quadratic. The thing that you need is that it has to be linear, or if it's linear, it needs to be capped. If it's quadratic, it already does that. So if you think of like the cost of pi being f of pi or something like that, then yeah, you have just implications. Yeah, effectively, all this, you just need a slightly convex cost function. And the slightly convex cost function essentially gives you that people search more the lower C is. And of course, that's in equilibrium, the value function is going to take that into account, your equilibrium search, and that extends basically how much you can promise. Because if people know you're going to search harder when things don't go so well, that makes the refinancing intensity higher, which makes the value of the firm go up, because they know when you're in trouble, you're going to find financing at a higher likelihood. So all of these things basically increase your borrowing capacity because the incentives are essentially aligned.
Increases the borrowing capacity, also decreases the probability of PE arising, right?
Not necessarily, because
Not necessarily.
C negative is basically PE arising. So if you have more borrowing capacity, you have more leeway when C goes negative, you might pay out cash early on the C positive side.
Mm-hmm. Okay.
Now, of course, what you're saying is derive the stochastic steady state or derive the cross-sectional distribution. It might be that because you refinance a lot faster, you don't really spend much time in the C negative space. Even when C upper bar goes down, we get reset there so quickly that C negative doesn't really matter. And that will basically go back to this kind of left graph here. When refinancing is a lot faster, at some point, these things decline, the activity declines, because it's just, even though there's a lot of borrowing capacity, you don't really need to use a lot of the borrowing capacity. I guess that would be the argument. Yeah.
Okay, thank you. Is there any other question?
Can I add one more question to the previous question, which is in thinking about the endogenous search effort, is there in some sense of a hold-up problem that the initial investors are incurring these search costs, but of course the benefits it's going to benefit also the intermediaries. Is there, yes.
Yeah, so
Mm-hmm.
because we have this restriction that alpha needs to be such that the people who take the search decision are not made worse off by the search decision. There's no issue there. Now, of course, alpha, this restricts the contracting space, because you would like to promise higher alpha because it relaxes the constraint today if I promise high alpha in the future. But there's a maximum alpha I can credibly promise to the intermediary, because they know if I promise too much alpha, I will not search. So indeed, if search becomes more expensive, I cannot commit to the same search thing and have the same alpha. And so then essentially the alpha shrinks and it becomes more binding. I'm just looking for an older version where we have I don't think at the moment it's in the paper, where we have the kind of cash risk sharing in it with endogenous search. So it's relatively simple. Here I have it. Yeah. Let me stop my share so I can share screen and preview cash sharing.
Yeah.
So yeah.
Mm-hmm.
Yeah, so here basically you essentially look at the gain that you can get from searching. So you pick pi, and so pi has a cost for you in terms of the firm needs to pay cash, and then of course it multiplies all these gains that you get. Now here, this is the full Kara version where alpha is also costly because it noises up some of the returns to the intermediary. And what you can see here is that essentially you pick to equalize, marginal value of search to kind of the marginal gain of relaxing the constraint. And so in linear search cost, you only search when you're far away from running out of money.
Right. It seems that like any potential, like everything can be contingent. The search behavior or there's enough contingency in the contract that would allow to resolve this problem of how much you should search. Is that correct?
Yeah, except
To say?
you cannot really choose it in the sense that there's a restriction on alpha, and the restriction on alpha, as you
Which
can
was
see here
there to begin with.
exactly. So the restriction on alpha kind of interacts with what you pick as a search intensity.
I see.
Because you could think I can make promises two ways. I can say, oh, you more easily can sell, or you more easily can raise money. If you think about it, I talk to the intermediary and I say, look, I give you a stake in the firm, and this is good for you because you can sell it off in the future. And then I say, what makes this more valuable? Well, if I pay you a lot upon me finding market access, that's alpha. Or if I say, I pay you the same amount, but I make it more frequent, I make your waiting time between me paying you lower, which is a higher pi. And essentially what we see, what the model does is it maxes out alpha, as in like that's the limit of what we can possibly do for our kind of search model, for our search choice to still be credible. And what essentially that is it says, we cannot make ourselves worse off by finding a refinancing opportunities. So we max that model out in that direction. And then we pick the optimal search intensity conditional on that. But a priori, it's not clear that we would have maxed that out. We might have left some money on the table in the sense that we could have said, okay, we only search if we make 10% for the current investors. We could have said that. So, and then we just search more. But the model says you don't do that.
Understood. Yeah, makes sense.
Yeah. I mean, we have risk neutral investors, so it's pretty clear that, you know, usually they're at some constraints, and then so it's not that surprising given our modeling techniques, I guess.